thanks very much for having us. As you say, very interesting subject, very topical subject, been in the news all the way through the current crisis and will continue to be, I think. And I'll give you a sense of why I think that is as well. So I'm going to kind of give an overview of the issue and look at really what other countries are doing, because I think we've seen in the field of kind of government action on bailouts and tax avoidance and support for business, kind of unprecedented amount of talk, and action from governments on this issue. So, I think we've got to remember that we've had a large bailout of the economy before, just 12 years ago in 2008 over the last financial crisis. And I think that has colored a lot of what is going on today in thinking in governments around the world. After 2008, we had more than a decade of austerity. And that, I think, more than anything else, brought into focus the issue of tax avoidance, and public got increasingly agitated about it, and governments got increasingly agitated about it, because simply from a fairness point of view, if you are cutting government budgets all of the time and in some cases increasing taxes, you don't the public feel aggrieved if they feel that others are not paying their way. And in 2013, you had the G8 Locarno Declaration that kind of committed world leaders to ending profit shifting by multinational enterprises. It started the OECD BEPS process. And that process, as of, the last week really, has kind of come to a shuddering halt and really is failing, with the US withdrawing from OECD talks. The issue of tax avoidance has been controversial before this current COVID crisis. In 2017, a poll showed that 89% of people believed that tax avoidance by multinational enterprises was morally wrong. And then I think, austerity and tax avoidance has been seen as a contributory factor to the COVID crisis, in the sense that people believe that that governments have not had the capacity to deal with the crisis in the way they should have done, and that's partly to do with the capacity of the state being run down. Whether people think that's fair or not, and I think this is really exemplified more than anything else in people like the Pope, who, in an interview with La Repubblica, which is the kind of one of the two big Italian newspapers, quoted an Italian journalist in full. Italian journalist Fabio Fazio wrote this article called The Things I'm Learning, and he had 14 points of what he was learning, reflections on the lockdown there. And the Pope cited only one of them in full, only quoted one of them in full, which is this one, which is, "It has become evident that those who do not pay their taxes are not only committing a crime, but murder. If there are not enough hospital beds or respirators, they too are partly to blame." So partly as a result of this kind of attitude, governments were very keen not to be seen to be providing support to companies that had been involved in tax avoidance in the past, or trying to deal with the issue through the bailout. And there's been a series of actions from governments, particularly in Europe. So the first was Poland on April the 8th. And the Prime Minister we did a kind of survey of what other countries had been saying. And in Poland, in a lot of these things, we don't quite know what the actual outcome is yet. They're often statements by politicians, but it was the Prime Minister who said that support would only be available for companies that paid taxes in Poland, and he said, "Let's end the tax havens," in his presentation on the issue. Denmark was then kind of the more famous one, but it was actually 10 days later. And they said companies registered in tax havens would be ineligible for government support. Austria followed suit shortly afterwards, pretty much the same policy as Denmark. France, Bruno Le Maire, the finance minister, the following day in a TV radio interview, said that companies with headquarters or subsidiaries registered in tax havens would become ineligible for support. The Senate then tried to pass a law on the issue, but the government said it was unnecessary because they could just do it by an administrative decree, which they said they did. Argentina is possibly one of the more interesting ones because they've been different from all the other countries in the sense that what they've said is that payments to related parties based in tax havens would be stopped for companies receiving government support. And that's also interesting. In South America, they can take a much more liberal view of what a tax haven is, which I'll come back to in a second. Canada, Canada, the Prime Minister, when answering a question in French, said that he would stop companies based in tax havens from receiving support. Asked the same question a day later in English, he refused to make the same commitment. So no one quite knew what was going on there, but the head of the tax authority in Canada said that applications for wage subsidy were being screened to stop claims from taxpayers associated with evasion and fraud. In Germany, the finance ministry tweeted that companies which evade taxes should have no claim to the state supports, but again, not clear what's coming with that. The big test is Lufthansa over the next few days, which is the first big bailout, as I understand it. And here in the UK, we forget that we have, various different legislatures doing various different things. So Scotland and Wales have actually followed suit in terms of what other European countries are doing. So in Scotland, there's legislation to block support to firms registered in tax havens or with subsidiaries in tax havens. And in Wales, companies owned by people or companies living in 100% tax havens are not eligible. I'll come back to what that means in a second. So a lot of these policies, as you see, focus around the issue of tax havens, and rather than tax avoidance, the use of tax havens being a proxy for tax avoidance in this case. And that's problematic because you then immediately go into the problem of defining what is a tax haven. Now, most of these countries are using the European Union list because, well, most of them have to because they're in the European Union. And the European Union list I have up there on the screen is quite limited. It's American Samoa, Cayman Islands, Fiji, Guam, Oman, Palau, Panama, Samoa, Seychelles, Trinidad and Tobago, US Virgin Islands, and Vanuatu. So, for all the American Samoan hairdressers out there operating in Denmark, be warned. But I think one of the issues is there'll be a public expectation about what these policies are trying to achieve, and it's not going to be matched by the policy when you look at the limitations of it. Wales has their list of, quotes, 100% tax havens, which is different. It's Turks and Caicos Islands, Anguilla, British Virgin Islands, Bermuda, Cayman Islands, Bahamas, and the Isle of Man. So interesting, it includes the British Virgin Islands and Isle of Man, which is not on the European Union list, but also doesn't have ones like the Seychelles. It was unclear for a while where that list came from, and it turns out that it's actually the Tax Justice Network's Corporate Tax Haven Index, and they've only taken companies that score 100 on their Corporate Tax Haven Index, which is interesting. So I think a real limitation in, again, not, as we know, tax avoidance is not simply, you don't just simply, register your company in American Samoa and then suddenly you don't have to pay any taxes. That's just not how it works. Lots of companies would not be caught by this kind of thing. Some high-profile companies might have been caught by it. So, it'd be interesting to know whether something like a company like Carnival, the cruise ship operator, which is joint registered in Panama, or Tottenham Hotspur, owned by an individual in the Bahamas, whether they might have been caught by these things. But The UK government has not implemented these things, so we shall never know. There's also a big concern by governments is the risk to jobs if companies are refused to support. Justin Trudeau, Prime Minister of Canada, I think put this quite eloquently. We do not want to punish workers based on the company they work for. They have families and communities that depend on them. We are focused on workers and not the company. And I think that is very much the thinking in the UK as well, not just from the government, but also the opposition as well. There is a real fear that if you refuse support to a large company based on perceived past misdeeds, then the consequences could be devastating. It also doesn't deal with the tax exile issue, which is really what a lot of people are angry about. If you look at the kind of stories that have come up in the press, Richard Branson, Sir Philip Green, etc. Virgin Atlantic is a UK registered company, and yet Richard Branson is on the front page of the tabloids, being pilloried for being resident in the British Virgin Islands. I mean, and he's actually resident in the British Virgin Islands, and he does live there. So you wouldn't deal with that through these kind of tax havens policies, and nor would you really want to. And I think there really is an interesting question about whether you do want to deal with tax exiles, but again, it's a different question rather than the one being asked. And I think that's a real risk, is that we kind of focus in the moments in crisis in these policies to deal with the immediate issues, then without really thinking about what do we want the tax system to achieve at all times, which is, I know, something that Heather's written about. In the UK, there have been calls for more action to be taken, including from the editorial board of the FT. Corporate bailouts should come with strings. And then, of course, Margaret Hodge, companies who avoid tax in good times shouldn't get bailouts now. And there are others too. The Fair Tax Mark has their Fair Tax Lockdown campaign, and I think that's been backed by the Labour Party. So there are more, but I think from what we've seen, as the UK is very lax in who it's giving its money to, not just from a tax perspective, from a number of perspectives. So we don't know who's been getting most of the cash, because over 50%. Well, we know over 50% of the UK businesses are taking a furlough scheme, but there's no published list other than for the COVID corporate finance facility, where the Bank of England publishes a list of companies every Thursday at 3 p.m. And there's about 60 companies on there. Soft loans up to £1 billion, some conditions around dividends and executive pay, but really not much else. And we saw that 6 of the companies were using Netherlands holding companies, one owned by Bermuda, another by Curacao, 2 ownership via the Cayman Islands, Bahamas, Jersey. So this is the kind of thing that actually some of the other countries' policies might have caught. But there's also one company on the list that's currently under investigation by the SFO for bribery and corruption. Another, which is it's Netherlands company which has been given the loan, but if you look at the UK subsidiary, its accounts are 9 months late being filed. I think that this is not obviously a tax issue, but I really think that raises an issue. So if a corporate can't file its accounts in the UK within 9 months of the filing deadline, which is already quite generous here, should the government be giving it soft loans? I think that is a big question. There's other conditions which could be brought in as well. And some companies entirely unaffected by COVID and with a minimal UK presence seem to be getting loans. So there was a big BASF was the one cited in the Times, a large German chemicals company, but managed to secure a £1 billion loan from the UK government, but only 800 employees in the UK, so more than £1 million per employee in terms of support from the UK government. So I think the UK has been particularly easy in the criteria around these things. And then, the interesting point, which I kind of will round off on, really, is that it looks now some companies are paying back money voluntarily, which I've seen in the press over the last few days. So you've seen Bunzl, IKEA have said that they are going to be giving back money around the world because they're not as effective as they thought they were going to be. Games Workshop, which is makes fantasy games. And I think that sort of thing is, it's obviously good PR for those companies, but it does introduce some real fairness questions about, should we really have very loose criteria then followed by relying on the generosity of companies to give back the support if they don't need it? Because I don't think that's realistic. I think actually you want probably kind of firmer rules, and then without asking people to be generous or good corporate citizens at the end, because we can't really set up our system like that. And then, as I kind of hinted at before, no transparency over who's getting the money, other than the CCFF. But I think that's a really important point. At the end of the day, a lot of these things are being administered through the tax system, so they have taxpayer confidentiality. But it's not what we normally would do. Normally, when we grant subsidies to companies through other agencies, that does have to be declared, particularly under EU state aid rules, about who is receiving money. And I think we have to look at that, because it's important the public knows where their money is going. So I think that that's a kind of my summary of where we are with these things, and I'll leave it there, and anyone wants to come back at the end, we can talk then.
Thanks, George. That was very interesting. Mute you. Very, very interesting and quick run through on that. I think the use of the word fair can be quite double-edged. I think there's criticism about HMRC's use of paying the fair share of taxes, so asking them now to, asking everyone else to be fair in their uptake of different government aid schemes can be quite dangerous. So if something is clearer cut, I think it would be better, perhaps. More to discuss a bit later. Glyn, over to you.
Thank you. Thank you very much. Thank you for everyone for giving up part of their evening to listen to me and listen to this. I should make it clear straight off that these will be my views, my personal views, based on my personal experience, and nothing I say should be taken as the view of the Chartered Institute of Taxation. So I come at it from the perspective of someone who at least twice in their career, has been involved in what I would call rescue finance for large corporates. And by that, I mean companies who've desperately needed finance either from a bank or from shareholders in order that they can actually continue to trade. And what restrictions have been placed upon those companies and what leverage the lenders of last resort have used in order to underpin their lending. So, the first thing I would say is, in those circumstances, the lender is interested in the trade continuing. So they are a stakeholder. They want the trade to continue because then they will get their money back. That's the best way of getting their money back. So in the same way that the government is interested in ensuring these trades continue because it wishes to preserve jobs, that's their stakeholder interest. The lender has got a similar interest. And I should also say that I'll be focusing mainly on the coronavirus large business interruption loan scheme. So this is the loan scheme available to the largest corporates, the ones that George has been mentioning. So what would I expect to see in a rescue finance package? I would expect to see restrictions on how the money could be used. As a lender, what you don't want to do is put a load of money in to a company and it then immediately gets siphoned off to shareholders or to other lenders, unless you are deliberately refinancing other loans, or to pension schemes, other than the absolute legal requirement that you're required to pay there. or potentially executive bonuses or other payments, other disguised payments to shareholders. And I think, when we look at the large business loan scheme, some of those elements are clearly present. You do have restrictions on dividend payments, share buybacks aren't allowed, and cash bonuses to executives have been stopped. There are no restrictions on payments to pension funds, which is, I think, from a government perspective, actually quite reasonable. I think the one thing that I'm a little bit surprised that they didn't look at a little more was other types of payments to shareholders. Royalty payments to shareholders. Yes, you may well need to carry on to use the intellectual property of a parent company, but a large royalty payment to a parent company in these circumstances could be seen as a way of actually sort of taking the cash back to the parent. Maybe one way around that is to say, we will allow you to pay royalties, but actually we expect you to make an equal capital contribution, or at least say 75% of that money that you pay as a royalty to come back as capital into the company to sort of reduce the leakage or potential leakage of loan funds. But that was not included. So, but to a large extent, what was in those restriction package is the sort of thing that you would expect to see in a rescue finance package. So 6 out of 10, 7 out of 10 for that. The other thing a lender will try and do is influence the risk profile of the company and ensure that it's engaging in the least, outside of the normal risks that it has to take in its trade. All other risks have been minimized to the greatest possible extent. And it's very common, it's almost universal, not only in rescue finance, but almost in any finance, to see an element of tax covenant in a large loan. And a tax covenant would say, we expect you to have filed all of your tax returns, to made all tax payments that are due. And if you are in any dispute with the tax authorities, that is either disclosed in the accounts, or if it's not disclosed in the accounts for any reason, it is disclosed to the lender, so they're clearly aware of what's going on. And any breach of those covenants, and then technically you're in breach of the loan, and the lender has then got remedies under the loan agreement that they may take up to and including, demanding repayment of the loan. And so what might you expect to see from a government who's asking as a lender of last resort in terms of tax covenants? Well, they might put in the normal things, but they know already whether you've filed your tax returns and whether you're in a tax dispute or not. But they have there's leverage there, and what the government could have said is, we're only going to lend to you if we think your tax behaviours are acceptable in terms of your UK tax, your UK tax, the taxes that you're paying in the UK. And by behaviours, I mean, are you up to date with your compliance? Do you file regularly? Are you involved in tax avoidance schemes? Have you got a history of that? Do you have long-running disputes with HMRC, where HMRC believe you've been involved in avoidance or evasion? And there is a measure already in existence for large companies, which is called the business risk rating. So every large company in the UK, operating in the UK, is assessed and given a risk rating by HMRC. And that covers a variety of things. It covers the complexity of the business, the number of taxes they have to pay, type of taxes they have to pay. But one of the factors is their behaviours and the extent to which they are open and honest, but open and honest with HMRC about their tax affairs, their disclosure of their tax affairs, how complete that is, and whether they are involved in tax avoidance. and the worse your behaviour, the higher risk you are rated. So there was an opportunity, I believe, that the government could have said, we will only grant you a loan under the large business interruption scheme if your risk rating on behaviours, on the behavioural side, not related to the complexity of your business or anything else, but on your behaviours is not at the higher end, at the lower end of the range. And if you are at the higher end of the range, well, yes, we will talk. Maybe we will still give you a loan, but that is contingent on you agreeing to move to the lower end of the range and to have put in place with HMRC a program to get yourself to the lower end of the range. And they could have done this without asking HMRC to breach their confidentiality. They could have put all of the onus on the company to disclose to the Treasury their risk rating, and if their risk rating was high, to disclose to the Treasury how they intended and what they had agreed with HMRC to bring this under control. Now, just to be clear, this would have covered companies who are what I would call bad boys, people who are involved in aggressive tax avoidance. They are involved in schemes or activities where they know that HMRC is going to disagree with the treatment of what they're doing. So it's that level of behaviour, or they are, quite frankly, so appalling with their general compliance that HMRC is, saying, we think we just don't trust the returns. They may be right. You may actually not be trying to avoid tax, but actually the standard of what you send to us is very, very poor. So that's the type of company it's aimed at. It would not cover. I'm going to say companies like Google. I don't know anything about Google's own tax affairs. I'm going to make the assumption that Google is not involved in what we would call aggressive tax avoidance in the UK. I think there are good reasons to believe that it's not involved in aggressive tax avoidance in the UK, because there have been so many attempts to increase the amount of tax that companies like Google pay. It suggests that actually what the problem with a Google is that it's able to reduce its tax burden in the UK by perfectly legitimate measures, such as the payment of royalties, payment of interest, and so on. And if it is involved in tax avoidance, it's probably involved in tax avoidance that is probably US tax that it's avoiding, not UK tax these days. So I suspect Google is probably paying, Google is probably now paying all of the tax that HMRC could ever levy on Google in the UK. The issue is that still probably not enough, but that's a fault of the tax system. And that's why we have the digital services tax and why we have the sort of issue, the negotiations going on at the OECD to actually move more taxing rights over Google out of the US and into the UK. So it wouldn't, I don't think, have affected the digital giants. So don't get excited that it would have done that. But what it would have done if they had adopted sort of a requirement for a lower risk rating, it would have ensured that no government finance or no government bailout was going to companies that were deliberately deliberately trying to flout what UK taxing rights, or being hopelessly incompetent to the point that HMRC didn't know whether they were paying the right, or without doing a huge amount of work, HMRC didn't know whether they were paying the huge amount of work or a huge amount for the right amount of tax or not. This idea was picked up, as some of you may know, by Margaret Hodge, who wrote to the Treasury, or wrote to Rishi Sunak suggesting that he insert it into the scheme, the large business scheme. Margaret took a sort of slightly more aggressive line. She said that you had to have a low tax rate. I think just a low risk rating, full stop, which is going a bit somewhat beyond where I was going with that. It still wouldn't have caught the Googles or the digital giants, but it would have caught a number of other. It could have caught a number of companies that might be high risk for non-behavioural reasons, which I didn't agree with. But I think her view was, if I don't ask I'll go for the maximum and hope I'll get something. The idea was rejected. Jesse Norman wrote back and said the main reason given was that they thought that risk ratings had a subjective element in them, which is definitely true. And therefore it wasn't appropriate to use them in this way. And they were concerned, going back to something George said, that if they had put this type of measure in place, companies that needed bailouts wouldn't have got them and jobs would have been lost. So they were very, they were stressing that they were doing these things to preserve jobs. Just one quick thing on the mechanical tests. I know George has already said he's not too keen on them. I would also say I'm not too keen on them. I think the reason I wouldn't go from saying if you're based in a tax haven, you couldn't get a bailout is, in the UK, you pay your taxes based on where if you're incorporated in the UK, you're UK tax resident, or if you're managed and controlled in the UK, you're UK tax resident. And I've worked with a number of companies over the years, for whatever reason, have been incorporated somewhere like Bermuda or Jersey, but actually are fully tax resident in the UK and pay all of their taxes and are better taxpayers than some companies that are incorporated in the UK. So you could have caught those companies, which wouldn't have been right. And the ownership question, as George says, if you're owned in a tax haven, well, the UK policy is based on we effectively don't tax shareholders on corporate profits. It doesn't matter where they are. It doesn't matter whether they're in the UK, whether they're in the pension fund, or whether they're overseas. Yes, if you're a UK individual, you will pay some tax on your dividends, but that's about the only time. We don't tax overseas shareholders, whether they're based in the US or the Netherlands or a tax haven. So, so in that sense, it didn't really make sense. Now. So that is that. I will stop there and hand over to Heather.
Thanks, Glyn. Heather, it's over to you.
Okay, thanks very much. Snag with everybody else has said, and thank you for your clients. I think there are two issues here, and one of them hasn't been mentioned by either of the other speakers. The issue that I think hasn't been mentioned is the question of timing. We're talking emergency support packages, which were put in place very fast. And
we can hear you, but we can't see you. I think it says low bandwidth or local computer conditions.
Okay, it's probably my internet. My daughter's probably streaming something. But what I was going to say is that we're talking about emergency measures. Of preserving jobs. And Glyn has talked about the CBILS scheme. I'd like to focus on the CJRS coronavirus retention scheme. It was quite a phenomenal achievement to put that in place in about 6 to 8 weeks from start to finish. There were some bumps along the road. The blessed guidance changed about 8 times, usually on a Friday night. But fundamentally, HMRC and the Treasury managed to put together a scheme that let people submit claims and get the money in their bank account within a week. That is really quite an achievement. If, as part of that, you'd also put various conditions on as to looking at ownership, conditions about think there would have been a real risk that the scheme wouldn't. And I think in this occasion, getting things in fast was more important than doing them perfectly. Can I just check? Are you still hearing me okay?
Yep, we can.
Glyn is nodding, so I'm presuming I'm okay. Okay, you frozen, so I wasn't sure whether you were hearing me or not. Okay. Another point on the CJRS is that it's an absolute condition of the scheme that all money must go directly to employees. So although the mechanism is to pay it to companies, employer or other employers, the money is absolutely going to UK individuals. Role. So as George pointed out, the quote by Justin Trudeau, if you're not careful by trying to constrain the companies who can claim, you're actually having an impact on the workers themselves. So I do think the timing is a really important point here. And in my view, we're probably better having something which is quick but imperfect rather than something which doesn't go through at all. Then you get to the question of substance. If we're only going to give money to good guys, how are we going to define the good guys? And Glyn has made some comments on that. I did look at the comments of Margaret Hodge and others, and I wrote an article for Tax Journal a few weeks ago. I will circulate the link during Q&A at the end, but briefly just to cover some of the points now. Started with Margaret Hodge's comments, if you don't pay your fair share of tax in the good times, it's offensive and downright wrong that you should have a right to access public funds in the middle of a pandemic. The difficulty I've got with that, and again, I think George made the point, we should be focusing on the behaviour we want to see. It's not really fair to penalise an entity for perceived past misdeeds. If we hadn't clearly said it was wrong in the past, is it fair to punish someone now? And there is actually an example of that in the CJRS and SEISS schemes, where there's been a lot of anguish from those who've operated through personal service companies who don't qualify for the self-employed scheme because they're not self-employed, they're employees of their personal service company. And they typically get very little from the CJRS scheme because most of them are taking a minimal salary, just enough to complete their national insurance contribution record, 8,500 or so, and taking the rest out as dividends, on which, of course, they don't pay national insurance. Now, Rishi Sunak was pretty blunt in his response to that. He said, those who pay less tax get less help. So at that level, primarily on the smaller businesses, they were being robust. And I think a lot of smaller businesses have felt that's been really unfair. There have been those who are running small personal service companies who have had practically no support from the government. My view on that is, yeah, I can understand Rishi Sunak's point of view. I can also understand the individual's point of view. My view is it would have been much better, give them the money, but the quid pro quo is you then increase the national insurance later. And I think there is something in that more generally, rather than punish people for perceived past misdeeds, say, okay, we recognize it's a crisis, we're going to give the money now, but in return, we expect something in the future. And that something in the future might be, as Glyn was saying, sort of specific even be some sort of COVID windfall tax. And I hate windfall taxes, having worked for a utility, we've got hit by them a couple of times. And windfall taxes are generally, in economic terms, a bad thing, because if you once hit an industry with a windfall tax, they never quite know when the next one is coming, and therefore it can disincentivize future investment. But I do think there's something to be said for, well, this was an exceptional circumstance. We gave exceptional support. Those businesses who needed it, fine. But if there are some businesses that didn't really need it and have made exceptional profits as a result of the way they've been able to trade under COVID, Amazon just might be an example, given how many packages arrive for my daughter every day. Possibly there is an argument to say, claw some of that back. Turning to, what else did I want to say? I think George has already covered the questions of tax havens. How do you define a tax haven? Is it actually going to be effective anyway? I think the other point I want to make is that we've had examples in the past of the government trying to use such things as public procurement rules to prevent offshore companies getting contracts. The absolute classic was HMRC managing to sell its own properties to Mapley, which was a company based in a tax haven, which caused huge embarrassment for a number of years afterwards. However, when the government actually tried to say, well, how can we stop doing that? It turned out to be really difficult to define a tax avoider in a way which complies with legal obligations. And if you look at the current procurement policy note on measures to promote tax compliance, it very much focuses on things that you can clearly point to somebody having done. So now bidders are required to disclose convictions for tax-related offences and specific occasions of non-compliance where a bidder has accepted that additional tax is payable in circumstances where anti-avoidance rules have been engaged. So you've done something which has been caught under GAR, or you've lost a court case, or you've reached a settlement with HMRC on something which was a DOTAS notifiable scheme. That is actually relatively narrow. But it has to be quite narrow, because otherwise you are introducing a subjective element. And we've seen in other big public contracts, and particularly if you think of the rail franchises, where Virgin successfully challenged the loss of the West Coast mainline contract a few years ago, and I believe Virgin Stagecoach are still challenging the current round. If any public process is not fair, to use a good word, transparent but objective, then a large company that's losing out can and will take action under using judicial review. So I think it's more difficult than it might seem to say we only want to give money to the good guys. And one final point, even if we did this, how much difference would it make? Support under the various schemes. Currently are about 23 billion for the CJRS, another 7.5 billion or so for the self-employed scheme, plus that deferral, plus lots of time to pay arrangements, plus all the various loans. The total package, I would say, is probably now more than the total that the government receives in corporation tax in any 1 year. I know the government's tax gap figures are not perfect, but if you take them as being a reasonable estimate, and they do publish their methodology, the total that they say is lost as a result of avoidance is 1.8 billion a year, and not all of that will be from corporates. Therefore, the risk is that you put in a lot of complexity into these schemes. You potentially make it difficult for the people who really need the money and haven't done any avoidance to get the money they need, because they have to jump through more hoops. And arguably, you don't actually gain that much from trying to stop the bad guys. So in summary, my view is I can see why people think it's not fair that companies owned by those in tax havens are getting government money. But as Glyn has said, that the money is going to support UK businesses. Any measures you bring in might stop the people who need the money very much anyway. And the better answer is, let's look to the future and say, how are we going to make sure that when we have to start paying this money back, that those who ought to pay it do pay it? So that's me finished. Thank you.
Thank you very much. I think it's important to keep perspective with all of these things. Media headlines sell news, but how effective are the points raised there?
I can just make one point of clarification, just picking up on a point. I would not have put any restrictions, and no restrictions being put on the coronavirus job retention scheme for the reasons Heather's given. So I would have, the only restrictions I would have looked to put in would be on the loan schemes, and in particular the large business loan scheme. Okay.
Right, we've got some questions coming through on the chat, so we'll get through as many as we can. The first one is, would the UK be better adopting the CCTB than the current corporation tax system? Anyone want to take that? Glyn or Heather, maybe?
Can I just say no? So, question whether you want CCTB or CCCTB. It's been bouncing around the EU for years. The difficulty, as with any system where you're trying to get agreement between a large number of countries is that it's easy to get agreement that something is a good idea, and it's very hard to get agreement on the detail, because either everybody's going to get the same amount as they did before, in which case what's the point, or you're going to have winners and losers, and the losers shout very loudly and the winners are very happy. So I just think it's not a priority for the UK at the moment.
Fair enough. Anyone got any other comments on that?
I'd say I agree with Heather. There's nothing else and I couldn't improve on that answer.
Fair enough. And I don't know if George is still there or not.
I'm still here. I mean, all I would say is I just think from a political point of view, joining in a European initiative right now is for the birds.
I mean, there is a wider issue which I know George and I have debated before, which is that the question of unitary tax, of whether it is better to have some sort of formula to apportion profits rather than the old arm's length is, I'm not sure, inching its way towards it, right word, crawling its way towards it perhaps. And again, any sort of formula is great in theory, but it's really, really hard to get the details applied in practice. My view would be that the UK is better having some robust anti-avoidance legislation and potentially shifting the burden of proof so that if the margin that a company is making seems ridiculously low, say, well, you show us why you're only making 2% when the average seems to be 5%. And George, that's a very sort of simplistic overview. Do you want to jump in on that aspect?
Yeah, well, I guess also, Glyn picked up on the Googles and so on. And I think Google is a really interesting case study because they've changed their structure in the last year. So whereas up until last year, you had a structure where Google Ireland basically sold into the UK and then paid out 45% of their income in royalties to a Dutch company, and then paid out 99.9% of their income to a Bermuda company, and collected about $13 billion in profits in Bermuda a year as a result. I think everyone can agree that's artificial, and because there is nothing happening in Bermuda like that company. Well, actually, it wasn't even a Bermuda company. It was an Irish registered company, which was tax resident in Bermuda. Now, that is a level of artificiality where everyone can agree that, that 13 billion that a year that is being accruing there probably should be going somewhere else. And then there's a question about whether that should be going to the US or Europe or wherever. However, now they've changed, or it's actually, I think they've moved all their intellectual property to the United States. So the tech company argument, which is most of our profits accrue in the United States because that's where all the work happens, I don't think was true when they were making that argument 2 years ago, but is probably true now. And how do you get a more realistic apportionment of profits between the US and Europe, which now is the real question. Now, we have a kind of system of apportioning things through the transfer pricing system as it exists. And I think the outcomes of that shows that it has been failing. There are other ways of apportioning income that are currently accepted under the OECD guidelines before we even start talking about changing them. So I think there's kind of lots of things that can be done, but you can't get past the kind of geopolitics of it, which is this is kind of Europe versus the United States. Yeah. And with the attitude of the current incumbents of the chairs, it's going to be extremely difficult to resolve. But I think,
But I think what is interesting, and my perception is that one of the big drivers for Google is the US finally getting round to implementing some much tougher anti-avoidance rules. I think the US guilty rules have made it much less worthwhile for US multinationals to stash profits in tax havens. And so I therefore come back to, if the behavior you don't like is income not being taxed anywhere, then by all means have a go at that. But I think a lot of the transfer pricing disputes end up being angels dancing on pinheads, because you're arguing about whether profits should be in the UK or France or Germany or the US. If all those countries have got a relatively mainstream corporate tax rate, I'm not sure that that's going to be very productive in the long term.
Yeah.
There's a whole other debate about whether you should have different transfer pricing rules to favour lower income countries, but that's probably beyond the scope of today's. can see a question from Sol.
I'll just add my,
Glyn, of course.
I'll just add, I think completely agree with you, Heather. If we're going to go away from current system, we have to go to something better. I don't think unitary tax is the answer. I think ultimately we will end up with a destination-based corporate tax, so that effectively you are taxed where you sell things, then effectively on a deemed margin. And I think that as Michael Devereux Oxford says, is the thing you can least control is where you sell things.
Okay. Right. So this is part observation and part question. So Heather, your comments chime with a recent High Court decision on Adiatu versus HM Treasury, where an Uber driver challenged the scope of the JRS on the basis that it unfairly discriminated against dependent contractors.
I saw that.
Yeah, the court took the view that it was better that the scheme be operative quickly and effectively rather than to be perfect, which is what you said is better to be done than perfect and not done. So the question is, do the panelists think that the UK government will use COVID as a cover for a proper overhaul of the UK tax system so as to eradicate or reduce the historical anomalies that have become entrenched within it?
I hope so. I think there's an opportunity to do that. I think Rishi Sunak has got the intellectual ability and has already, in his comments about personal service companies, has hinted that he's up for it. The difficulty is that Johnson keeps saying, oh yes, but of course we're going to meet all our manifesto commitments, except when I say we're not going to meet our manifesto commitments. It takes a reforming chancellor with the support of a prime minister to get real change done. Now, we've got some things in favour of that. There is a reasonable parliamentary majority, so it should be possible to get less popular legislation through. You've got a chancellor who seems to be up for it. However, whether Johnson will support him is a much more difficult question. The IFS did the Merleys report, and it's now shockingly about 10 years ago, where they set out what they saw as key principles for a rational tax system. Unfortunately, it had a bit too much endogenous neoclassical growth theory and was unintelligible to a lot of people, I think. But they're coming back to that and trying to look more practically at, if we are to move to a more rational tax system, what are the areas we should focus on? And I think the taxation of labour income is a key one, because there are distortions at the moment. It makes a difference precisely how you decide to trade. The other one, which has had a lot of attention recently, is the triple lock, which is just becoming unaffordable. Now that's going to be hugely unpopular, and I think if you take money away from older people who are very vocal and tend to go out to vote, and to count on their votes next time. But in order to get real change, you need a chancellor who is prepared to push things through and be unpopular. I think this chancellor potentially is prepared to do that, but whether he will have the backing of Johnson and others in the cabinet is a much more difficult question. Be interested in your views, George.
Well, I mean, I think when you raised the issue of Rishi Sunak at the beginning saying, oh, we've got to change the tax for the self-employed. And I was really surprised he kind of did that, because I think it's one of those things, oh, we've been talking about this for years. Now is a real opportunity to show why this is important. But then I think he didn't really think through the consequences of the fact that then, having broached the dam, he then has to do that with everything. And you know, the thing that I ask is, okay, if you're going to say that about the self-employed, why not say that about tax XRs and all the other issues that are coming up? And I think the other thing that's interesting is, you know, we talk about, like, think about the people who've paid for themselves out of dividends. And I do have some sympathy with, you know, the way that it was so endogenous to the system, but also think about the people who haven't paid themselves with dividends, and they have a very different view, and people who've just been putting in their self-assessment tax returns every year. And I was on a focus group a couple of weeks ago with people from the West Midlands, and a couple of self-employed hairdressers on there who were not happy with the idea that people with personal service companies should get any treatment whatsoever. You know, their idea was like, I've been sitting here for 20 years filing my tax return every year. why on earth should these people get anything, right? And they were very hard line about this. So, you know, I think those often there's lots of groups who come into a crisis with pushing their agenda, and this, you know, smart politicians understand that. Then there's lots of people who don't really say much because they're not trying to push any particular agenda, but they don't really agree with the agenda that's being pushed, and that makes politics a bit complicated as well. I don't know if that answers anything to do with your question you put to me, but
unfortunately, tax and politics are very closely intertwined when tax can be a very academic subject. In terms of the personal service companies and that issue, part of the reason for taking dividends rather than, you know, paying PAYE and taking a salary is because A, the legislation permits it, and B, call it the additional rewards, if you want, of running your own business. But it's something to offset the risk of going into business on your own. If you do have a look on the internet and find the answers that you're looking for, you know, people who are on personal service companies, my personal view is, okay, if you haven't paid into your national insurance and the PAYE, then fair enough, you shouldn't expect a bailout, because you went into business on your own to be independent of that system in the first place. So then you shouldn't be able to rely on it. So that would be my view and the view of a few others I've spoken to. Glyn, do you have any thoughts on that?
I don't think we should have got ourselves into the situation in the first place where people were relying on dividends to pay them their annual salary. We shouldn't have allowed that to become a way of remuneration. You know, a dividend should be a return to the capital that you've put into the business. And I have a lot of sympathy for the government on this issue, because it's very hard to distinguish between someone that has is using a personal service company, someone who is actually effectively not taking money out of the company, or take as little money out of the company as they can, because they're in a startup phase and they're trying to reinvest everything in the company, hoping that they can build it up. And someone who is genuinely, you know, is taking a salary and then taking a you know, a significant return on their capital invested. So I think they were on a bit of a hiding to nothing. But, you know, fundamentally, the system had allowed these various models to grow up, and it should never have done so. So I do hope Rishi Sunak does tackle this. What I would say is, when you look at the income distribution, there are anomalies and distortions all the way along. At the lower paid level, the interaction of benefit levels and tax can result in marginal tax rates of 70%, which is a nonsense. You have the self-employed versus personal service company versus employed, where effectively you can have three people doing the same job and they are taxed at different levels on the same remuneration, which is, again, a bit of a nonsense. And then you have the higher end of the higher end. You can have you know, people involved in private equity, where they're, through the carried interest mechanisms and other mechanisms, they are effectively making a certain amount of money over a period of years, but a large amount of it is being classified as capital gains and being taxed at significantly lower rates than marginal, you know, the marginal rate if it was an income, it was being taxed to income tax. So you've got anomalies all over the place. I think there's probably enough to go at in reforming income tax and trying to get a more equitable form of income tax before you even start on the taxation of wealth, for example, which is another matter entirely.
I was going to say, when you start talking about equitable, there'll be different people with different versions of equitable, just as with fair. But the only other thing I'd point out on that is the GAR panel did look at specifically whether taking out dividends instead of salary was permissible, and they said that it shouldn't come within the remit of the GAR at all. It's within the legislation. And what you're saying about the anomalies, and we're talking about tax reform, it is something that very much has to be addressed by reforming the legislation rather than what the media report in the newspapers, which drives the reform, I suppose, in a way as well. Okay, we'll take one last question, and then I think we might have to call it a day. So Sol has written on the chat, I think it might be easier if you read this at the same time. The most sophisticated attempt to describe international tax avoidance structures in law is the EU Directive on Reportable Cross-Border Arrangements, DAC 6. Would a better approach be to require the board of any business applying for a bailout to certify that either it does not have a reportable arrangement in place, or that any reportable arrangement has already been reported and found not to entail tax avoidance?
And I can see that Keith just posted a response saying that the difficulty building on DAC 6 is similar to the problems experienced by the use of DOTAS as a guide to whether APNs should be issued. Disclosure rules should be designed to encourage disclosure and not purport to be a guide as to what's unacceptable conduct. Again, there's a timing issue. Although DAC 6 is in force, the first reporting isn't due. It's just been, I think, postponed till the 31st of October. We still don't quite know what's got to be reported. While some of what would need to be reported is definitely what everybody would agree is tax avoidance, it's also a big information gathering mechanism. For example, any movement of hard to value intangibles needs to be reported. So agree with the idea, Sol, that you need a clear definition of what you want to be reported, but DAC 6 isn't there yet.
And Keith is nodding. Glyn is nodding.
I think on that as well. I mean, I think it would feed into the kind of idea that Glyn was talking about. Right? I mean, if companies were making, and I think the other thing is, and I agree with Heather's point that in a crisis you need to make sure that people have money in their pockets so they don't starve. And that's really important. But if we believe what the stuff coming out of economists is, this is going to be a problem that is going to persist for a long time, and the government is going to have to be active in intervening the economy for a long time. So we can think about these things moving forward as well to refine how we approach these things. And I would have thought that reports under the DAC 6 framework would feed into the risk ratings that HMRC come up with, and if there are companies that are reporting artificial tax schemes, that would put them into the higher risk category. And then going back slightly to what Glyn was saying during his discussion, and what the government's response to that was, well, that's a bit subjective. Well, at the end of the day, you can't get away from that. And it's actually, the government is constantly saying, what would the private sector do? Well, the private sector would take a subjective view on whether or not to lend somebody money or not. And so why shouldn't the government take the same opinion based on the information it's gathering through mechanisms such as DAC 6?
And I think that comes back to what I said earlier about the parallel public procurement, where you do have that sort of reporting requirement, but it's not an automatic disqualification from a contract. It's a question of providing details of what's happened and mitigating factors. So you might, for example, be able to disclose a DAC 6 issue, but then say this was only reported out of an abundance of caution. It's clear there's no tax avoidance, and be able to demonstrate that you weren't actually committing something that the government objects to. So
I would love to know how many applications have ever been refused under the government's procurement guidelines on
that might be a good question to ask.
Brilliant. Okay, I think we'll leave it there for tonight. If anyone has any more questions, I'll put my details in the chat, and you can do that. I can forward it to Glyn, Heather, and George as appropriate. Our next talk is next Tuesday, and as everything's opening up again, we've got Claire Taylor back in to talk about employees' rights going back to work under COVID, I suppose, and what they should be expecting from their employers. So hopefully we'll see a lot of you again then. Otherwise, good night.
Thank you.
Thank you for your attention, everyone.
Thanks, everyone.
Thank you.
Thanks all the speakers.